So in terms of the property sector, which is going to get hit the most in any recession, UK property year to date is down 23%. Infrastructure and infrastructure funds down 8%, and also commodities down 11 as well. So areas that are very economically sensitive or subject and normally do well in inflationary times, they're all being hit, and that is likely to carry on. I spoke to our fixed income team before this meeting about their view on inflation in view of what happened in the US a couple of weeks ago, where the Fed said, they were looking to see what would happen if inflation came back in terms of numbers. And our fixed income team do not think that inflation is a likely threat or resurgence. And they expect bond yields to stay very low, inflation to be sub 2% for at least the next year, and similarly for bond yields as well. So no inflationary threat, yields staying low, and then that comes on to what the government response is going to be to this sort of very slow recovery. The government response so far, as you know, has been the furlough scheme, and we are now at crunch point as that unwinds in October. We know from the latest insolvency data that firms who are filing for insolvent or going to file for making people redundant as a result of insolvency, they filed, and therefore we can see the numbers of unemployed ticking up at least 3 times the rate for the next quarter. So at some point there is a crunch where the government will have to decide whether to extend the furlough scheme, introduce some new form of government support that hasn't been mooted yet, or let unemployment spike higher and see what happens as regards COVID and the numbers of cases coming down. So in other words, get driven by health policy rather than economic or finance policy. Our own view is that we think either the furlough scheme will get extended or there will be another scheme put in place.